As far as the BRICS countries are concerned, they're in a very difficult position because America is extremely powerful. They owe money in dollars where they owe money, or currency rather, and consequently they don't want to upset their bankers. So they're not in the business of running around and telling everybody how awful the American government is and how they're destroying their currency and all the rest of it, and we're going to sell it off. No, they would rather keep quieted things. Now, a very good example of this is India. India does a huge amount of trade with the West, and it's not in its interest to rock the boat on currencies at all. And it's only recently, actually, that India has sort of decided to start protecting herself by accumulating gold reserves. And, they haven't finished doing that. I mean, it's quite clear to me that they need to get their reserve position up even further.
Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button, and join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pin comment. Stay ahead of the curve. Don't miss out. The reason I think that India's got left behind is that it's gone through a period of Keynesianism, informed by us, because we've been responsible for the appointment of governors of the Reserve Bank of India. That's something which the Bank of England has always been consulted on. In other words, it's someone who we approve of, or the Bank of England approves of, ends up being governor. And by definition, that's someone who follows the same sort of economics, if you like, that the Bank of England and the UK Treasury follows, which is Keynesian. So, or neo-Keynesian, if you want to put it that way. So, countries like that, I do think have a problem. They know that, the Western system is dying on its feet, but they can't sort of just break away from it completely. I think that this, if you like, feeds into the problem that China has, because there is absolutely no doubt that China has accumulated huge amounts of gold off balance sheet. And not only that, but she's encouraged her citizens to accumulate gold as well, which they have to the tune of something like 27,000 tons. These are huge numbers. Not very much on a per capita basis, but huge numbers nonetheless. And as far as the Chinese are concerned, I think they know that at some stage they're going to have to protect their currency by putting it on a gold standard. But they don't want to do that too soon, because if they do that, they will destroy the Western financial system, because immediately everybody in BRICS will go and do the same thing if they're able to, or they will try and link themselves to the Chinese yuan, again, to protect themselves against the accumulation of follies that we've perpetrated on ourselves and therefore on everybody else. So the situation, I think, is actually quite delicate. And this is one of the reasons why I think the timing, if you like, of the collapse of the currencies could be, a bit closer than we think, rather than a long, drawn-out procedure. I mean, we've seen the purchasing power of our currencies decline over, huge amounts over long periods of time. I mean, I would say if you look at the relationship between the pound and the sovereign, I mean, originally £1 was one sovereign, and you could exchange a paper pound for one gold sovereign. There are now 550 paper pounds for one sovereign. Now, that is a huge, great loss of purchasing power for the sovereign, for the pound. And other nations, have had exactly the same experience. I mean, if you look at the way in which the purchasing power of the dollar has gone down since it was 35 to the ounce, it's now close to 3,000. Mm-hmm. You've got, the yen has gone way down. The euro and its previous constituents has gone way down as well. I think that's around about 1% of where it was. So, these losses are now likely to accelerate from here, which I think is really quite catastrophic. In today's news recap, silver price forecast.
Silver sees upside above $33.40 on soft U.S. PPI and CPI Trump tariff fears. Silver price trades close to near the monthly high of $33.40 in North American trading hours on Thursday. The white metal strengthens as cooling United States consumer and producer inflationary pressures pave the way for the Federal Reserve Fed to cut interest rates in the June policy meeting. The U.S. Producer Price Index report showed that the headline and core producer inflation decelerated at a faster than expected pace to 3.2% and 3.4% respectively in 12 months to February. Month-on-month headline PPI remained flat while the core figure deflated by 0.1%. On Wednesday, the U.S. headline and core consumer price index rose by 2.8% and 3.1% respectively in February, slower than their estimates and their prior releases. Last week, Fed Chair Jerome Powell stated that the restrictive monetary policy stance won't long last if the labor market unexpectedly weakens or inflation falls more than expected. The scenario of lower interest rates by the Fed bodes well for non-yielding assets such as silver. On the global front, escalating economic risks due to U.S. President Donald Trump's tariff agenda have also improved the safe haven demand of the silver price. On Wednesday, Trump confirmed that he will respond to counter tariffs from the European Union. Such a scenario would result in the EU-US trade war, which will diminish the risk appetite of investors significantly. The cautious market sentiment has also increased the safe haven demand of the US dollar, but U.S. economic risks and soft CPI report have capped its upside. The U.S. dollar index, which tracks the greenback's value against 6 major currencies, rises to near 103.80 from its 4-month low of 103.20, which it posted on Tuesday.
On the audience, where I've been invited into a central bank, I don't actually say get the hell out of credit, which is what I would basically say to an audience, if you like, of investors, of individuals. But really, I mean, the answer really is that if you agree with me that it looks like credit is going to decline in its terms of its purchasing power at an accelerated rate, which, if you like, conventionally we would say inflation is going to pick up again, then you really want to get into something which is stable. And of course, money, in terms of its purchasing power, by which I mean gold, has been stable over millennia and will continue to be so. I think gold at the moment is beginning to discount some of the future collapse of the purchasing power of currencies. But you would expect that at a time like this. And this has certainly begun to move higher, for example. But if you look at many other commodities, I mean, the sort of commodity complex is only just sort of beginning to turn round and is beginning to look sort of interesting in investment terms, as it were. But the fact that gold is so far ahead, I think, is a clear indication that that is the direction in which everything is going to go, which, of course, reflects the fall in the purchasing power of currencies. That's really all that's happening. I mean, when you see copper rise, when you see nickel rise and all the rest of it, and silver as well, it's loss of purchasing power of the currencies being reflected in those commodities, not necessarily demand for those commodities. And I think this is the point which analysts thinking in terms of constant purchasing power for dollars, because they account in dollars or sterling or whatever it might be, this is a point they all miss. They don't understand that actually what's happening is it's not commodities going up, it's the currencies going down. And that's going to be the major driver, I think, for commodity values in the coming years. But it's quite hard to separate out the two, I think. I mean, I have no doubt that, in America, there is this sort of view. It's a very sort of domestic view that the dollar is, That's what we account in, and nothing else really matters. And the idea that the Fed, if you like, should try and manage things in the light of the effect on the dollar is wholly alien, I think, to individuals in America. They don't understand, I'm sure this is right, they don't understand the dynamics that drive the dollar against other currencies, except to the extent that so long as the dollar is the numero uno of currencies, then what are we going to worry about? So I think it's quite simple. As far as the BRICS countries are concerned, they're in a very difficult position because America is extremely powerful. They owe money in dollars where they owe money. Or currency rather, and consequently they don't want to upset their bankers. So they're not in the business of running around and telling everybody how awful the American government is and how they're destroying their currency and all the rest of it, and we're going to sell it off. No, they would rather keep quiet at things. Now, a very good example of this is India. India does a huge amount of trade with the West, and it's not in its interest to rock the boat on currencies at all. And it's only recently, actually, that India has sort of decided to start protecting herself by accumulating gold reserves. And, they haven't finished doing that. I mean, it's quite clear to me that they need to get their reserves